Hello traders, so welcome to this video. In this video, we are going to be looking at a scalping strategy for beginners. Okay, so if you are new to trading and you are still trying to, find your way around the market, then you are in the right place. Okay, we're just going to be looking at an effective strategy that you can use for scalping the market. All right, now we're just going to be starting with essential indicators to watch. Okay, very important indicators that can guide you when you are scalping. Okay, the first one we're going to be looking at is the moving averages. Okay, the moving averages. Now I'm just going to add on the 20 EMA to the chart. However, I'm just going to be explaining what this average or this moving average does. Now the EMA, which is the exponential moving average, um it is an indicator that helps you identify the trend and potential reversal points. Now, for scalping, some common periods used are, you can use maybe between 9 to perhaps 25, there about 9 to 21. There are important, there are common periods that can be used. You can use 20, you can use 10, you can use 9, and all of that. So but for this video we're just going to be using the 20 EMA. Okay, so basically how you use this strategy, you have to use it on the smaller time frames, perhaps 15 minutes or even 5 minutes or 1 minute. Okay, depending on how fast that you want to be opening and closing your trades. Okay, so this moving average basically shows you the direction of the trend and potential reversal points. So when you have price trading above it, it means it's a bullish trend and you might want to be looking for buy opportunities only. Yes, and when it's trading below the moving average, it indicates a sell trend, and I want to look for sell opportunities only. Okay. Now we also have the simple moving average. Simple moving average is a it's an indicator that also helps you identify the direction of the trend. Shows potential trend reversals, but it's not as fast in reacting to price compared to the EMA. Can you see that EMA is usually closer to the candlesticks compared to the SMA? Now, for the purpose of scalping, we're just going to be using the 50 SMA to gauge the overall market trend. The 50 SMA to gauge the overall market trend, and we're still going to add on our, let's just use 21 EMA. Okay, while we are using the 50 SMA to gauge the overall market trend, you can use this 21 EMA to identify potential reversal points. Okay. Now, another indicator we're going to be adding for this scalping strategy is the RSI. We're going to be adding the RSI to our chart. Okay, the RSI helps us to measure the speed and the change of price movements. So a reading above 70 indicates overbought conditions, while below 30 indicates oversold conditions. Okay, this can help you identify potential reversal points. For example, when we notice that price was around here and then the RSI was below the 30 level, as you can see, it indicated oversold conditions, and as the RSI began pointing upward, we can see that the price reacted accordingly and the price began to reverse. So the RSI can help you identify potential reversal zones. Okay, another indicator that we can use for our scalping strategy is the Bollinger Bands. The Bollinger Bands are also effective indicators that can be used for scalping. So the Bollinger Bands consist of a middle band, which has an SMA, and two outer bands, the upper band and the lower band, that represent standard deviations from the SMA. So when price touches the lower band, it indicates a buying opportunity, basically. And when price touches the upper band, it represents a selling opportunity. As we can see, from the upper band, the price sold down to the lower band, and from the lower band, the price bought up to the upper band. Okay. Now, another indicator we are going to be considering is the stochastic oscillator. The stochastic oscillator is another important indicator. This is a momentum indicator that compares a particular closing price to a range of prices over a certain period. Now, values above 80 are considered overbought, while those below 20 are considered oversold. So when the oscillator is in the overbought region, you might want to consider exiting your buy trades or entering a sell trade when you have a bearish crossover. On the other hand, when the oscillators are inside the oversold zone, you want to consider exiting your sell trades and possibly entering a buy trade when you have a bullish crossover. Okay, another indicator we are going to be considering for our scalping strategy is the volumes indicator. Okay, the volumes indicator can help you to analyze volume, and it can provide insight into the strength of a price move. Okay, high volumes on a price breakout can confirm the trend. So whenever you see a spike in volume, as you can see around here, a spike in volume, there is something likely about to happen. So when you have a breakout and you see a spike in volume, for example, it can show that that breakout is probably valid. But when you have a trending market and then you see price bouncing off maybe the moving averages or maybe bouncing off your trend line or something, and you notice a spike in volume, it could show a potential continuation of that trend. Okay, now these are the indicators that you can use for your scalping strategy. Okay, now in terms of risk management, it's important that you define your risk per trade. Limit your risk to a small percentage of your trading capital per day. Okay, per trade, sorry, not per day, per trade, because in one trade, you can consider typically between 1 to 3% of your capital that you'll be risking for one trade. Okay, it helps protect your account from significant losses. And then it's important to use stop losses as well. Limit your risk to a small percentage and then use stop losses to prevent unexpected market movements wiping out your account. Okay, it helps to find your maximum loss even before you enter the trade. And then in terms of position sizing, try to calculate the appropriate position size based on your risk tolerance and stop loss distance. So you're gonna use the distance between your entry price and your stop loss to determine the size, the lot size you're going to use for your trade. Okay, it ensures that you're not risking too much on any single trade. And then it's important that you diversify. Okay, while scalping typically involves quick trades on a few pairs, diversifying your trading pairs can help spread the risk. Okay, however, avoid over diversifying as it can dilute your focus. For example, if you have about 2 to 3 pairs that you are trading, it's okay. Yeah, you can scalp across a couple of pairs, like a few pairs. You can scalp across a few pairs. Okay, but when you start scalping across 10 currency pairs, 15 currency pairs, it becomes too much. It becomes too much, and it can dilute your focus. You might end up losing a lot of trades because of your focus is too diversified. But if you are focusing on just a few currency pairs, you can be able to effectively scalp across them. Okay. Now it's also important that you regularly review your performance. It's important to keep a trading journal to track your trades, your outcomes and emotional responses. Regularly reviewing your performance can help you refine your strategy and improve future results. Okay. Now some traders might be wondering, especially beginners, because this video is for beginners, right? So if you are considering what pairs are the right pairs for you, okay, some factors to consider include liquidity, volatility, correlations, economic calendar, and the time of the day. I'm just going to be looking at each of them briefly. Okay, in terms of liquidity, if you are a newbie, you might want to focus on currency pairs with high liquidity, such as the Euro USD, that is this pair, the euro against the dollar. Another example is the GBP USD, which is the Great Britain pound, or the Great British pound against the dollar, the US dollar. Okay, so the euro USD and the GBP USD are pairs with high liquidity that you can focus on. High liquidity ensures greater, it ensures tighter spreads and less slippage. Okay, and those are very important factors for scalping. Now, another thing to look out for is volatility. Look for pairs with adequate volatility to create price movements that can be capitalized on within short time frames. Now, this particular pair, being XAU USD, is one of the most commonly traded pairs in terms of volatility. It's quite volatile. Okay, it has quite some high volatility, so you can consider this pair gold against the dollar if you are a scalper. Okay, and then in terms of news releases. News releases usually impact the market, and it enhances volatility during that period. So those are things that can affect volatility, both news releases and economic indicators. Okay, now in terms of correlations, be aware of correlations between pairs. So you might want to avoid trading highly correlated pairs simultaneously, as this can increase risk exposure. For example, if you have correlated pairs, maybe like the GBP USD and the Euro USD, there you can kind of try to spread your risk across some pairs that do not um, maybe have the same currency pair, the same currency in them, or even if they have the same currency in them, you can just look at the price movements of those currency pairs and know if there are some similarities in the way the currency pairs are moving. If you notice some reoccurring similarities, then you might want to consider other currency pairs. Okay, so try as much as possible to avoid trading very highly correlated currency pairs. Okay, so that you can minimize your risk. And then in terms of the time of the day, you might want to consider trading during active market hours when major financial centers overlap. Okay, e.g. the London and New York sessions. So you can consider trading during the London and the New York sessions. This typically results in higher volatility and liquidity. Now, in terms of psychology, it's important that you consider psychological aspects of scalping. Yeah, in terms of emotional control, scalping can be stressful due to rapid decision making and market fluctuations. So you might want to practice mindfulness and emotional regulation techniques to maintain composure. Okay, that's very important. And then to practice discipline. Stick to your trading plan and avoid impulsive decisions based on emotions. Okay, having a well-defined strategy helps you maintain discipline during volatile market conditions. And then accept losses. Yeah, it sounds somehow, but learn to accept losses because losses are a part of trading. Accept them as learning opportunities rather than allowing them to affect your emotional state. Okay, focus on long-term results rather than individual trades. That's very important. And also avoid over trading. Resist the temptation to enter trades simply for the sake of trading. Okay, set specific criteria for your trades and wait patiently for the right setups. And then now in terms of routine and breaks, establish a routine that includes regular breaks to avoid burnout. Okay, you are a human being. We are human beings, so you have to learn how to take breaks. Okay, you don't have to glue yourself to your charts all day long. Okay, now taking breaks helps refresh your mind and can improve decision making. So basically, by incorporating these indicators, risk management strategies, trading desk selection criteria, and psychological techniques into your scalping approach, you can enhance your trading performance and maintain discipline in a fast-paced trading environment. I hope you found this video insightful. Kindly like and subscribe for more trading insights. And don't forget to hit the notification bell so that you don't miss out on more trading updates. Thanks for watching. Happy trading.